The S&P 500
Classic
touched
sailboat formation.
a record high this week. Our next guest says stocks are climbing a wall of worry. Steve Houston, m+funds partner, joins us now as I turn the volume off on my MacBook. What we're watching here, people clearly are nervous. We see that rushing to gold. People are looking for yield. Are you going to get yield in equities? Doesn't look like it.
It's exciting for investors given we're hitting these levels. There's also a fair amount of anxiety. If you've been long the market or if you're watching the market and wishing you had been, in the market. So it's kind of a dilemma at these levels, how you allocate and deploy new money into the market.
And so how do you solve that dilemma?
Yeah, so, at m+funds, we offer what are called defined outcome funds. And so they provide a predetermined payoff on ETFs that clients use and at a predetermined maturity date. So everything we do at m+funds is linked to the big ETFs that people use in their portfolios. SPY for S&P 500, EFA for non-US equities, and they provide enhancements to those, either long the market plus principal protection or enhanced upside on those ETFs, and again at a stated maturity date. And so those funds that we offer with principal protection, where you're still long the market but you have downside protection, in this market they've been particularly popular.
But at the same time, presumably you still have to have a view on where you think the market is
Indeed.
going.
Yep.
If you want to get to those targets that your clients want to achieve. So do you think that we'll see further upside from here, for example, particularly if the Fed cuts?
Yep.
Do you think we're range bound? What do you think happens?
Well, it seems to me, and we're not market strategists, we sort of offer funds that allow the advisor and clients to capture their views, to be honest. But let's face it, right now, the market feels pretty good. We have a president who seems particularly determined to keep this rally going. So notwithstanding issues in the Gulf and so forth, you sort of want to be long the market, at least for the medium term, but certainly having some element of downside protection is resonating with a lot of the folks that we talk to.
So we had heard earlier in the year that maybe there's going to be a melt-up, or we're already in a melt-up in equities. I mean, from where you sit from the fund standpoint, do you see us in that melt-up, or we haven't hit it yet?
Look, we're up 7% in June, I think. Well, probably more today, just given the numbers. 17% year to date feels like a melt-up. Historical averages are certainly well south of that. So it feels really good right now, but certainly we feel a little bit of anxiety about these levels.
When you talk about protection with these funds, are you going to the bond market? I would seem that's an
Great
incredibly
question.
dangerous place to be right now to try and be purchasing some protection.
We're not. And so there's only one asset in our funds. Ours are registered funds. Anybody can buy them. We only hold exchange-traded options. And they're call options to provide upside, put options to provide downside protection. And that's actually what creates the defined payoff. When these funds mature in 1 year, 2 years, 3 years time, there's no guesswork. What you see is what you get. And those options are static. They're put into the fund on day one and we walk away. I mean, there's a daily liquidity at the fund's NAV at 4 p.m. every day, but they're not actively managed. In fact, we don't even charge a per annum management fee because they're static.
Interesting.
Yeah.
The reason I was asking about the bond situation was when people say protection, it always sends up a red flag. With your clients, it's not a guarantee of return, or is it?
It is. It's a specified return that those listed options, they mature on the same day as the maturity of the fund. And so when we issue new funds, they have a very specific payoff profile. For instance, the principal protected funds will guarantee your capital at maturity if the market was to fall below today's level, for instance. So if we hit a recession or if the market sells off a lot, like it did in the fourth quarter in December. And so clients, I think in some ways, particularly at these levels, are looking for that level of confidence. If they're going to put new money, for instance, into the market, it's a sensible way to think about it.
And one thing that a lot of people who are watching us right now might want to consider. m+funds partner Steve Houston, thank you for being here.
My pleasure. Thanks for having me.